Industries that are hot, sectors set to outperform the market. That's what's here in Zacks Industry Rank Analysis. Our senior market analyst at Zacks.com, Charles Rotblatt, puts this report together for us each week. He joins me once again to elaborate on this week's compilation, which seems to be focusing, as far as his radar is concerned, on earnings overall. What's going to be the key for investors in this 3Q earnings season?
Well, it started off on Tuesday night. We had just absolutely horrible earnings from Alcoa, missed by a wide margin. But Alcoa is a really bad proxy for how earnings season's going to occur.
Yeah, because aluminum prices have been going down around the world.
Right, and I think in the case of Alcoa, they actually have missed expectations on several times in the past. So even though they're officially, and I put that in parentheses, the first to report, they tend not to manage expectations very well. So I think when you look at Alcoa, you've got to kind of put that to a side. But when we do look at third quarter earnings and what they're going to do, it's really a case of glass half full, glass half empty scenario. I think when you look at the index level, we're looking at earnings estimates going to be down about 5.5%. And that's taking the entire S&P index and weighting it. Now, if we look at a medium company, what every company is going to do with no weighting whatsoever, we're looking at growth. Probably, I think, after earnings surprises, probably the high single digits. So it really depends. It's going to be company specific. And I think one of the key things that's important for investors to understand is that about 60% of the companies in the S&P 500 are going to report year-over-year growth and profits. So it's not going to be an absolutely horrible earnings season, but by no means is it going to be great either. And we're going to have some companies that are not going to do so well. So it's important for people to look at earnings, but I think it's a really scenario where you need to look at it an industry by industry and a company by company basis.
What industries are you going to be focusing on if you had to pick the top three this season?
Well, I think one of the things for investors to do is really kind of focus more on large cap, less economically sensitive industries versus going for the ones with the very strongest growth. And that's one of the things I highlight this week in Industry Rank Analysis is some of those more conservative industries. One of them is medical products. I talk about Becton Dickinson. It's a medical products company. It makes a lot of syringes. Diabetes care is a very big market for it. And regardless of what the economy does, if you're a diabetic, you need to have your insulin shot, and you're not going to not take it because the economy is slow. You're going to figure out a way to get that as long as you have insurance. So I think that's pretty good. I talk about Intuitive Surgical. They make robotic surgery equipment. They're heavily involved in various cancers, such as prostate cancer treatment. Right. Again, something where someone can't put off saying, oh, the economy's bad, I'm going to hold off doing it. If your life is at risk, you're going to do something about it. And this company, therefore, should continue to see positive revenue streams coming in.
You also talk about aerospace and defense and Oilfield Machinery and Services. Now, I'm going to go right to the Oilfield Machinery and Services sector. Has oil seen its day here and just is not reflected yet in earnings, but will be, especially in the fourth quarter?
Well, I think oil is still trading pretty high, and I think to expect oil is going to suddenly fall off the cliff is a little unrealistic. Oil, if you look at it year over year, is still doing pretty well, and it's still very expensive. And I talked specifically about Smith International in the Industry Rank Analysis column this week. They make everything to get oil out of the ground, from the rig floor to the drill bit. And so for this company to really not do well, you have to look at oil really falling below the $65 per barrel range, and I don't see that happening. China's using more oil, India's using more oil, and as much as high gas prices affect consumer spending here, people really aren't making a significant move to cut back on fuel consumption. So if anything, we're going to see oil consumption only rise in the future, not go down, even though we might see fluctuations on a short-term basis. And so we're looking at a case where if you're not going to see oil fall off the cliff, oil companies are going to continue to invest in getting out of the ground, continue to invest in maintenance, and that's going to benefit companies in oil field services and equipment such as Smith International.
You talk about nearly 60% of S&P 500 member companies expecting to report year-over-year growth this earnings season. Is that a little bit optimistic?
I don't think it is. And a lot of companies, really, if you look at the second quarter, July and August were still pretty good. September, things started tightening up, but the economy still did okay. It didn't do horrible. It didn't fall off a cliff, and a lot of companies get business from overseas. We'll see some positive impacts of currency translation, not as much as we saw in the second quarter, because certainly the dollar strengthened a little bit. But a lot of companies, despite all the bad news, a lot of companies are continuing to make money. They're continuing to sell products. And we're really looking at an economy that's slowing, not falling off a cliff, not halting. So I think for a lot of companies, you will see that growth. Now, when we start looking at the fourth quarter, it starts getting a little more questionable, and we'll really have to see what the actual impact of this credit crunch is and how long it lasts and how severe it gets.
All right, you can read all about it, the full text version of Charles' industry rank analysis this week, by linking to it off of our homepage at Zacks.com. And with Charles Rotblatt, I'm Terry Ruffalo.